In every M&A deal, there's one number that quietly makes or breaks the entire deal, and it's not the purchase price. My name is Mubarak Shah. I'm a CPA. I've worked on over 100 deals in the lower middle market, both buy side and sell side. And my goal today in this video is to give you the masterclass on understanding working capital. If your business requires a significant amount or even any amount of working capital, it's just crazy to me that some people will just disregard working capital. Yes, it's a complex topic, but it's super crucial to make sure that you have a fair and equivalent deal. The problem with working capital is that no one really knows what it is. Any entrepreneur, they don't run their business on working capital, right? It's not shown up on your P&L, it's not on your balance sheet, it's not in your bank account. Working capital, it's more of an art than a science, right? So there is a negotiation, there is a back and forth. Let's start off in the basics, right? What is working capital? So working capital is the difference between a company's current assets and current liabilities, all right? And so current is usually within the period of 1 year or less. What that means is its ability to fund operations and meet its short-term obligations. The formula for working capital is current assets minus current liabilities. You start off with current assets, right? And that's things like accounts receivable, inventory, prepaid expenses. And then on the current liability side, you'll have things like accounts payable, customer deposits, deferred revenue. But in M&A, in business buying, the regular working capital is more of a finance metric. You're gonna hear about net working capital, or NWC. And that's basically the same concept, except for the fact that you have to subtract cash and debt. When you close a deal, the seller keeps the cash at close, all the money in their bank account, and they're required, though, usually on a debt-free deal, to pay off all of the long-term liabilities associated with that deal, right? If they know that, hey, I'm gonna keep all of the money in the bank account at close, they're going to operate the business differently as you're getting into close. If I'm running a business and I know that I can keep all the cash at close, I might just do a fire sale of my inventory and my fixed assets. And so the net working capital, though, prevents that and keeps it in a way where it's cash-free, debt-free, but make sure that the seller operates the business in their ordinary course. And if they don't, the purchase price is going to be adjusted to make up for that difference. The big issue is that a lot of times these sellers, especially in lower middle market deals where, let's say, we're sub 10 million in purchase price or sub 20 million, they might not even have an accurate balance sheet for you to pull these numbers off of, all right? And so it becomes difficult sometimes where your lender or your seller or the broker is asking for you to come up with a net working capital target peg to put into the LOI, and they don't even have accurate balance sheets, or they might not even be on full GAAP accrual basis, which is what's required for you to really understand the working capital. Your goal as a buyer should be that you want 2 months of working capital, one given to you from the seller and one from the lender. The way that the seller is going to give it is they're going to leave it in the business. That's going to be usually the way we look at it is that we'll look at the trailing 12 months. We'll look from October 2024 to September 2025, right? Trailing 12 months. And we look at the balance sheet and we do that formula. We do current assets minus current liabilities. And then you'll remove all of the cash and debt, right? Because these deals are done on a cash-free, debt-free basis. And the average of that is going to be your net working capital target peg. Trailing 12 months might not be the best approximation, especially in a fast-growing company, because the numbers have changed, right? Your business, if you're growing, if you're doubling year over year, the business is going to have a much higher working capital need this year than compared to last year. So what people will do is that usually, like, for example, if I'm doing a quality of earnings, we'll look at the 3-month average, we'll look at the 6-month average, and we'll look at the 12-month average. And then whatever is highest for us as the buyers, we'll try to negotiate that. You as a buyer, you will want the highest amount of working capital, right? You want the sellers to deliver the largest working capital to you. And again, because we just talked about the fact that they don't leave any cash in the bank account, this isn't actually money that they're going to leave in the bank accounts. This usually comes in the form of accounts receivable and inventory and prepaids, right? So those are intangible things, right? You can't spend accounts receivable, you can't spend inventory. You have to wait for those items to convert into cash. That is why we get 1 month from the seller. So they'll leave in that amount of either an accounts receivable inventory. And then you also get 1 month from the lender. And in order to do that, you need to usually have a DSCR of about 1.5 or above. The working capital target is something that always ends up being a negotiation and sometimes can even blow up deals. But the problem is you need to just make sure that you have the right definitions because it's a highly misunderstood concept. I think it'll be easy if I can help kind of break down the different stages of the M&A process, right? So the first stage obviously is a letter of intent, right? So in the LOI, you just keep it broad. You agree that you have this purchase price, but it's going to be based upon a reasonable amount of working capital. You don't need to necessarily establish the exact number. In fact, you don't even have enough information to accurately do that. And that amount will be determined during financial due diligence. We don't know the working capital number until 45 to 60 days after LOI. Really, we need to wait until we're post LOI, we've gotten a quality of earnings, we've done the financial due diligence, and that's when we can actually get to the right working capital target to put into the purchase price. Here's the other tricky thing about working capital. So we've now, let's say we finally, negotiated, we've done the quality of earnings, we found out that it should be about 500,000, right? No company in the world has their books closed or their accounting fully up to date. So you use an estimate. If I am the seller and we agreed on a 500K working capital target, and now on the day of closing, I only have 400,000, you, the buyer, can reduce the purchase price by 100,000 to make up for that deficit. And in the same way, it's the flip side. If I deliver 600,000 of AR at close, then you either need to pay me, the seller, 100,000 extra because I'm giving you more than I promised, or usually what happens in reality is that because you're working with the SBA 7A, the loan people, they've only already kind of allocated a certain amount of capital. So usually what happens is that you'll negotiate with the seller at that point. When the money comes in, I'm just going to pay you the extra 100,000, right? So it becomes kind of more informal in that scenario. In our example, we made it simple, but now imagine we were talking about inventory, right? Inventory, and we're talking about a $10 million business. We don't know the exact stock count. No company in the world, especially once you have large inventory, there's theft, there's returns, refunds, there's spoilage. We give an estimate, and not until 60 days, 90 days later do we actually know what the final true working capital balance ends up being. So you have to have a final post-closing settlement adjustment, because if my estimate was wrong, we need to go back and fix that. A lot of buyers that I advise and counsel, like, they might think that, hey, oh, I know the seller doesn't have the counsel like you, Mubarak, like we can just push it through, they're gonna be fine with whatever number I say. That sounds all good and dandy until later on, when we're trying to actually get the right estimate. If 60 days later after closing, you go to them and say, hey, listen, you messed up on the working capital, you owe me another 200,000, they're gonna freak out, right? And I've seen lawsuits break out over this. I've seen, companies shutter because then the seller is just like, hey, no way I'm paying that. A lot of times you need to keep a healthy relationship with the seller, right? Because you need to rely on their knowledge transfer post-close, and for the transition, they're still usually helping you out. But this is why it's important to be able to negotiate it and understand it. And so hopefully this was a good formula and understanding as to how to incorporate net working capital. So if you have any questions, feel free to reach out, and I'll see you guys in the next video. Thanks.